Alpha episode. This is episode 172, and we have a very special guest on today. Her name is Mandy McAllister. So Mandy is a multifamily real estate investor, mindset ninja, eternal learner, coach, and dot connector. She followed volleyball to Mercer University in Georgia, where she was awarded top graduate in marketing. Soon after, she moved to Chicago to do a master's in economics and began work at the Board of Trade. Her professional career transitioned to medical device sales, where she was a perennial top performer. After many years of chasing commission, she has made it her mission to secure financial freedom to her family and others through syndications and coaching individuals to realize their personal potential. So her real estate expertise includes repositioning underperforming assets to increase cash flow and value. Her portfolio is currently comprised of 205 doors, primarily B-class workforce housing. So Mandy has found success in college towns with student housing as well as urban centers. Her passion to help others define her path to financial freedom, especially women, through her platform, Aspiring Women Achieve More, which of course you can find on Instagram and Facebook. Those links are going to be down below. She's the most proud to be mama of her hilarious 4-year-old son, Duncan, who is coincidentally wants to be a real estate investor when he grows up. So here you go, generational business we're going to be talking about as well. So of course, mandymcallister.com and email and Facebook and personal Instagram, everything is going to be linked below. So make sure to go and follow up with Mandy after this interview is over. So Mandy, for you personally, I want to say a big thank you for coming on today. I appreciate it.
Oh, thank you. I'm so pumped to be here.
Thank you. Thank you. A pleasure to have you on. So listen, let's begin. And can you talk about your personal kind of journey? I mean, how do people come across, multifamily business? There's a lot of people talking about rich dad, poor dad story and that, how the book kind of, so can you talk about your personal journey? How did you get involved into this business?
Absolutely. Yeah. So back in college, I remember being at this party. One of my most real estate investing formative memories is I was at a friend's party and she was talking about her dad bought the house that she was living in that the party was at, and she rented out the rooms to some of our friends. And I thought, and you get to keep that money? This is the most brilliant idea that I've ever heard in my entire life, right? So went from there to the Board of Trade, where I saw guys lose money in an instant. Lots of guys in 30 seconds lose millions of dollars. So the idea of hard assets, like my dad, who's a farmer, you don't just lose ground like that, like you lose paper assets. So it was always kind of in the back of my mind that real estate investing was something that made sense. And through the crash of 2007, 2008, I bought thinking I would reposition or live in a condo for a little while and rent it out with a BRRRR strategy type thing, and didn't really go time frame as planned. But starting in 2016 was the first time I bought an asset for express purpose of investment, and it happened to be a fourplex. And I realized, holy cow, this is immediate scale. I'm never going back. I want to add a zero to the end of this. Let's run directly at it and run it like a business. So that's kind of how all of the happy mistakes that landed me in multifamily.
That is awesome. So again, there's a lot of people, and you probably, guys and girls who are listening to these episodes or watching on YouTube, you find that there's a lot of people getting involved in multifamily business. I mean, it makes a ton of sense. And if anybody who's here watched a couple episodes, but can you explain for the people why to choose multifamily route instead of, let's say, office space, maybe not in this current times, but maybe investing in hotels or self-storage or anything else that commercial real estate can offer?
So in my opinion, the things that draw me most to multifamily is, number one is where someone lives. If you look at Maslow's hierarchy of needs, one of the primary things people will always need to go for is shelter. So if you can buy that shelter in a place where lots of people are going, that's supported by, population growth and GDP growth and job growth and all of that stuff, you're really in a not foolproof, but as foolproof as possible spot in terms of your investment. Why multifamily over single family? For me, I think in our space of multifamily, many folks will talk about, I should have gone bigger faster. Well, for me, the mindset stuff behind the, analysis paralysis, fear stuff, the doing a fourplex layup for me put me in the ball game, which kind of strengthened that muscle. So I believe in walking before running in some cases. So, multifamily offers this opportunity for better lending, for better loans that are non-recourse. So the bank only takes that loan back and not the rest of your assets, which is hugely beneficial. And it's locked in long-term low rates. And, that scale that you can get right off the bat, that's really why I love multifamily.
Got it. So again, the same reasons kind of, that everybody, when they look into multifamily investing. So got it. So what would you say for the people who are looking to invest? I mean, during this time, so if you're watching this episode, you're still during the COVID. So today is 1st of December. So here we go. So it's still in the COVID and whatever country you're in, level 2, 5 lockdown type of situation.
Yeah.
So what type of breakthrough mindsets, moments can we talk about? And maybe we can give some personal take of yours, let's say from active investing and passive investing, because, there's a lot of people concerned what's going to happen with the future, with their jobs, with businesses. So how people can go and start real estate business, let's say just like multifamily without, concerning, well, I don't know what's going to happen in the future, or passively invest in those type of deals.
In terms of active, another thing that I would like to, chat on briefly that I don't hear a ton of people talking about is, I hear people talking, you should be active, you should be passive, whatever. Why can't you be both? And you need to own everything as a team, or you need to own everything by yourself. I believe firmly that you could have different buckets in your investing strategy. For me personally, I have what I call my security bucket, which is my small multis that I start with. That's really just me, that kind of provides this floor of cash flow, so that when I move to, doing this solely without a day job, then I've got this floor of earnings that I can depend on. And then I have my growth bucket, which is the big syndication stuff. So I think it's important to understand that you can do both simultaneously. So in terms of active investing, what I'm looking for, what my team is looking for is, right now we're in this incredible uncertainty. We don't know where things are going to go. And there is inherent danger in they're throwing a ton of money into stuff when cap rates are this compressed. There just is. So for me, whenever I'm looking at numbers, I look at best case scenario, I look at worst case scenario, and then I look at what's really likely to happen. So when I run those numbers, if I'm talking to an investor for a potential bringing them on as a passive investor, we're only going to talk about what's likely to happen and what, the worst case scenario is and how we're mitigating that risk. So if I personally, as an active investor, can get comfortable with that worst case scenario, that's when I know it's time to move forward. Then we talk about what's likely to happen and we manage towards the best case scenario. So in terms of being a passive investor and an active investor, what I want right now in this atmosphere is a bunch of different outs. Like, I don't want to be locked into one business plan to make anything happen. I want to be able to have a number of exit strategies so that if it does hit the fan, if things do happen in a way that we didn't think of, then we're protected in many ways.
Got it. So what do you think, because again, you own both, either syndication and self-owned properties, small multifamilies. So what do you think would be the right strategy for you personally? Would you lean towards self-owned properties, or are you still going to continue to do syndication?
I'm doing both because I've got those buckets, those individual buckets, right? So I'm kind of an opportunist. I mean, I hear many of my contemporaries in multifamily syndication say that, oh no, I'm not going to, spread my focus and do a fourplex. Well, I completely believe that, staying completely focused on one thing so you can get really granular is so important. But once you've been doing things long enough, you can have a mild expertise in a couple of different areas. So for instance, if my property manager from where I have my 4-unit and my 6-unit come to me and they say, hey, listen, there's this similar property and this is why we think it works, I might buy that, because it works into something that I have a significant knowledge in and everything kind of buttoned up. But when it comes to the bigger stuff, you know, I feel like you need to be really comfortable with that downside, no matter which you're doing. And for me, I'm willing to do both right now. I just need to have more long-term scope on what I'm doing.
Got it. So it makes a total sense for me personally because uh, number wise, and again, the way you do syndication deals, people get paid on that. Some of that portion of the profits can go into smaller units, and you grow the smaller units at the same time. You go bigger on syndication, and you do both at the same time. Because look, I mean, at the same time, what you're looking at JLL or any Cushman & Wakefield, anything that you have the property. So LoopNet, some people
Yeah.
probably looking there too. But when you're looking for those properties, you come across a 4 unit and you have access capital available to invest in it. It's a Chicago area, looks good. You run through the numbers. Why not? At the same time to have something that you personally own. But a lot of people, we had some guests on the show. They had $1 billion in syndication because that's only what they do. And some people, in the near future, you guys will see a guy who owns multifamily, but he just owns his own personal stuff. And both of those people are, again, running their personal strategies, and it's best for them, So again, what you do is, I think it's smart at the same time, because having both, it makes sense. So again, can you talk about those deals? And again, Chicago area, because I'm guessing all those deals are in Chicago area, right?
I don't love Chicago. I don't think Illinois I don't think it's a well-managed state. I think that our politics have kind of gotten ahead of us. And, our most recent acquisitions have been in Indianapolis. And I want to, call back to what you just said there. And, as a person who's kind of coming up and building this, I kind of started from no property and not a ton of money. I kind of earned it all myself as I went. So the opportunity to have that floor of passive income from my own personal owned stuff provides me an opportunity to not have to do a deal. When looking at syndication, some syndicators live off their acquisition and disposition fees, and that works for them. But I know me, and I don't ever want to be in a position that I have to do a deal to feed my family. So the dual strategy puts me in that position that I never have to do a deal. So in terms of market selection, Illinois has kind of this mass exodus of people. Jobs are going to other spots. I don't think Chicago's going away. I don't. But, even through COVID, so my very first rental is a condo I used to live in like one of the hottest neighborhoods in Chicago, the West Loop. I can't give it away. I cannot give it away. It's, I have it 20% less, listed 20% less than the exact same unit sold for this time last year. So it's happening in all of these major metros that people want to move away from these large areas. So, first off, I want to not be in a city center. And then second off, I want to be in an area that has this strong job growth and strong population growth. And that's not Illinois. That is Indianapolis.
So can you talk about Indianapolis in your personal decision-making process of when it comes to the market? Is there specific, places within the market that you're looking for? What type of main drivers for you that when it comes to making those investment decisions?
Yeah, absolutely. And I think that's kind of shifted since COVID, So, like I said, I don't think people will want to live in a 90-story building because they're scared of people sneezing in a way that they weren't scared of people sneezing a year ago. Yeah. So I prefer now these kind of low to mid rises so that people can have a little bit of green space. I think those are more desirable. In terms of why Indianapolis, for me personally, it's a 2.5, 3-hour drive from where I live. So it's not quite my backyard, but it's kind of my backyard. And I have my younger brother lives there with his family. So for me personally, why that made sense is I'm managing that asset. I'm asset manager on that for my team with my business partner. And, I can get down there frequently. So the diversity of employment is also very important to me. They've got, tons of different types of jobs that they're growing in. So Indianapolis is very attractive for a number of reasons.
So can we talk about, again, because you're living 3 hours away from Indianapolis, and can we talk about how did you find those deals? Was it through existing relationship? I mean, how did it came up?
So my business partner is a broker in Chicago, a real estate broker, a commercial real estate broker in Chicago, and he is incredible at the thrill of the chase of the deal. You know, this is what he has built his career on for 14 years. And a number of commercial brokers kind of cover a few markets or have moved over time. So he has had those relationships for some time. So we ended up finding this most recent 53 unit that we did through relationships that he had. And he had closed other assets with them. So it's just like everybody says, if you're a buyer, then you get a ton of attention, a ton more looks at properties. You're the pretty girl at the dance, as I say. Everybody wants to hear what you have to say. So we found it through a broker relationship.
Got it. So how much of that 205 unit portfolio is syndication and your personally owned properties?
Yeah, so 22 units is just me. 53 is a joint venture, and 130 are syndication, which actually just went full cycle. So it's you know, trying to figure out where to recycle cash here too.
Got it. Got it. So when it comes to multifamily, can you talk about specifically what you're looking for, your kind of decision-making process when it comes to property location, year, and what type of value add strategies you're looking to implement in those type of deals?
Yeah, so great questions. So part of what has informed how I've most recently started looking at things, you know, our space has become pretty crowded. You know, there's lots of people that are looking for a 200 unit value add property in these top 10 growth markets. So my thought process is, how do I get the stuff that I need, meaning the growth markets or whatever, and give up something so that I'm looking at deals that not everybody is looking at. So for me and my team, the idea of, you know, we can still get the really good Fannie or Freddie agency debt, the long-term non-recourse debt, if we do a smaller property than a 200 unit. So we're looking, I mean, we did a 53 unit. There weren't a ton of people looking at it, likely because of size, and also because it was a stabilized asset. It doesn't, you know, it's already, the value was already added from the previous team. And for us, what's most important is the long-term cash flow. So we put a 15-year term loan on it with 8 years of interest only. So we're really just juicing this asset for cash flow. And we know that the team before us did a really great job of the rehab. So, you know, there will be rent bumps, but there's not a tremendous value add upside. However, we're going to be able to ride this out for 15 years if we want on the loan that we've got. So it's a different type of strategy than you hear most syndicators go after, which is why it kind of worked for that joint venture setup that we've got, because there's only 3 of us.
Got it. So, and can we talk about the property management? Because as I understand, you self-manage your own properties that you personally own?
No. Well, no, I have property managers on everything.
Yeah.
But the 53 unit, we have a property manager who does the same size assets, actually owns their own assets in that same market. So, you know, we're very comfortable with their knowledge of you know, how things go in Indianapolis. The types of assets that they own that are nearby are different. So I'd say we own a strong B+, and their local asset to where we're at is probably C minus. So it's not a question of, are they taking tenants from us or whatever. So for my smaller stuff, you know, I have a full-time job that's, you know, pretty demanding, and I'm a single mom. So, you know, my time is spoken for. So to take phone calls on toilets is not, you know, in the scope of what I'm able to fit into my schedule. So, you know, I've had really great property managers. I've had property managers that aren't so awesome that I probably should have made different decisions on. But, you know, it's run the gamut, but I have property managers on everything.
Got it. So can you give an advice for people who are looking to invest in real estate, let's say multifamily actively, and they're going to be looking for that property management? You know, can you give a personal lessons, as you said, I shouldn't hire those people, and when it comes to B assets, because some people are saying, okay, if it's a B or A type of asset, let's say it's A asset, never hire somebody who manages C, or if it's a B, don't do A, so, and vice versa. So can you do a personal take on kind of how do you vet and know if the property management company is going to be the right for you?
Absolutely. So what I'll tell you is the story of the happy accident where everything went incredibly right. And then one that was the next one that didn't go so incredibly right. So my very first, the fourplex that I bought, it was a student housing situation that I knew that if I plugged into, a property manager that did that I would have a better chance of achieving the gains that I wanted to. So I, spoke with kids who had just graduated from college and said, if you at Illinois State University, if you want to rent an apartment, who do you go to? They told me 2 property manager names. I talked to both of them and I picked the one, guys, they think very similarly to how I think. I asked a lot of questions about, how do you deal with problem tenants? What does turnover look like? What, lots of, how do you deal with hard stuff questions? And, you can ask those questions, but you never know until you get there, right? But I liked the, attention to detail and vulnerability, and, they run their own assets. So I've asked about the problems that they've encountered. So interviewing them up front, getting a really good gut feel on this is a human that I would like to work with, and I like the way they think about things, and I like their track record, was very important to me. Then my next acquisition was in a market that I didn't have any other assets in, and I had a friend. I had made a friend through networking stuff that was a friend first, and not having the hard business conversations first, and let that organization run my property. And I was kind of spoiled by the first one in terms of expectations of communication, expectations of how the hard stuff would be handled, and didn't, think to ask those questions on my second asset like I did on my first, because I was friends with this. And so, my big advice would be small asset, medium asset, large asset. Have those hard conversations, check the track record, talk with people who have had properties managed by them, because they're going to know better than anyone.
Got it. That's a good advice. So what about picking a right partner for, let's say, joint venture projects, because you can go on those type of deals and you find out that those are the right people for you to be, JVing with. So how can you vet and know if that person is going to be the right one and will not cause any problems along the way?
I've messed this up too. So this is actually a pretty, I feel like I have some do what I say, not what I do advice to offer here. Because again, it's a pattern. I went into a joint venture about year and a half ago with a friend who I knew a ton about the single family space, but, hadn't done a ton in multifamily. And I was going to help out, in terms of making a syndication happen, raising capital for that multifamily, and investor relations, all that stuff. So anyway, my gut instinct told me, we need to do something small first. We need to do something so that we have this working relationship so I can see how you operate. And, long story short, it blew up in my face. I lost a bucket of cash, and I'm still working to get that back. So my advice there and I will do this from here on out, that again, those hard questions that I felt like I had asked of that partner that it went poorly with. And I thought that, we went to church together and our 2 kids played together. So I thought I had this really, solid foundation. But, what I should have done in a deeper way is a background check. And I should have, dug deeper into previous partnerships, to, asking those questions of talking to other people, because I would have known that that was not an ideal situation to go into. So every single partner I will have from here on out, I'm doing a background check on. And if that feels weird to that person, then I'm going to have this opportunity to have an awkward conversation. And that's really what any kind of partnership is. If you're in a friendship, if you're in a marriage, if you're in a partnership for a joint venture, your ability to address an awkward conversation is what decides if that relationship is good or bad, you know?
Yeah.
So it kind of sets me up for a win in both ways.
And I think that's a very great advice right there, because personally, I've seen people that I encounter myself, and if those people, talking about God all the time, and somehow, I don't know, it's some sort of pattern, it's just those people always comes into me, and when they talk about God too much, I'm like, something is too sketchy about those people, because I'm a believer. Look, I'm a believer. I pray every single night before I go to bed, but you don't hear me talking about God all the time, and how I want to bring the God to the people, and I want to, church and the Christ. So when people talk about that, and you see in the videos the cross is behind them, they talking of it, something is sketchy about those people, I don't know. Of course, there is great people, who talking about that, but from a personal experience, they always come out as, in your situation, something happens, with that.
The thing is, like, that for me personally, and my opinion is that relationship with whatever universe, whatever, that's for me. That's not for me to, and that's just my opinion. But I think you're right to have things that kind of make the hairs on the back of your neck stand up, and then to investigate it, because maybe that's not the case. And I know tons of people who are very devout that do speak about their faith, that are very trustworthy. But I don't disagree that when things look showy, that I think this is the bigger thing. When things look showy and I'm trying to make things look good rather than be good, then that's where the problems lie.
Exactly. So yeah, make sure always to do your personal due diligence, and of course, trust your gut, but still, as you mentioned, ask hard questions and take the time, as they say, hard, slow, fire, fast, so hard, really talk with them and go into the details and everything. So that's very important. So talking about your personal deals, so you're going to be looking for more stuff in the Indianapolis area, or you're going to be looking for other markets as well in the near future?
So, we want to grow. The one downside to going after these smaller assets is the scale piece. A reason to take down a 200 unit property is to have dedicated property management. And we don't have that because our footprint in Indianapolis right now is just those 53 units. So, we do want to grow that footprint so that we can, kind of achieve those economies of scale in the Indy market before moving on to somewhere else. So we are actively looking. We have walked probably half a dozen properties. We've put LOIs on, 3 or 4 of those, and we've been a runner-up in a couple of them. But we're staying very close to those brokers because, those brokers know that we're performing buyers, and we have, capital locked in, and we have everything, all of our ducks in a row in order to take down these assets, but we're not going to buy just to buy. We need to make it work for our kind of cash flow focused plan. We're acquiring in Indy actively.
Got it. So, right. So yeah, because a lot of people that I come across with that I have on a podcast or just talk on a day-to-day basis, they're talking, I get what you mentioned, compressed cap rates. It doesn't make sense from my underwriting standpoint to invest on those type of deals, maybe, smaller JVs or maybe mobile home parks or storage units. So on that note, are you looking, let's say maybe in the long run or currently right now, into some other commercial asset classes at the same time?
I am not. I know how to manage where people live. I feel like I understand why people like storage, but in terms of my FOMO, shiny penny syndrome stuff, I need to really stay in the lanes that I have a significant amount of knowledge. And that's how I make sure my focus stays, and frankly, if we're talking value add space right now, if you're buying this is another thing that I haven't heard a ton of talk about, but if you're buying a 4 cap, right? If you're buying something on a 4 cap, and cap rates will, expand to a 5 within the time frame that you're going to sell, call it 5-7 years, not entirely outside the realm of possibility, right? So if you're going to go from a 4 cap to a 5 cap, 5 exit cap, that is a 25% difference, right? 1 point from 4 is 25%. That means in order to just keep up with the value of the property to sell at the same price that you bought, you have to increase your NOI by 25%. So I feel like this long-term strategy of making sure that it's cash flow that I can hold and watch what's happening in the market is what matters most right now to me.
Got it. Yeah. So it makes a little sense, instead of, as I say, going and, catching another shiny object, which a lot of people do at the same time. And they think it's great because, look, people, I think, who watch these episodes all the time, they probably understand there is no one right recipe for real estate investing or investing in general, because we had on people on the show who talking about the stock trading and their top stock traders in the US, or their multifamily investors, real estate investors, wholesaling, flipping, Airbnb. Everybody talks about that it's the right strategy, which is not. I mean, it's the right strategy for you, if you're looking to pursue what you want to pursue, you want to become the best in multifamily, do that, because people go and read one Warren Buffett quote, diversify, and they think that's it. I have to go and chase everything, which is not true, because the biggest people that I had on the show that are crossing $1 billion mark are those who are focusing on one or two things. So maybe that's the right strategy. So I love it. Good.
So Andrew Carnegie said that, your note on diversification, Andrew Carnegie said, put all of your eggs in one basket and watch that basket. Right. So in my opinion, my master's is economics. I used to be a trader. I was on the floor of the board of trade. Like, in my opinion, Warren Buffett's idea of diversification is for wealth preservation. Yep. But in terms of wealth growth, because I'm a farm kid, this is kind of all my doing, this stuff that we're in here. So I've got all of my eggs in one basket. I've got them diversified within that basket with those different buckets that we talked about, but I'm watching that basket,
Exactly. That's a great advice. So that's the right approach, personally, at least for me. So because we talked about before we started recordings, you said, let's talk about juggling stuff, and time management and how do you create time. So can you talk about that, being busy, growing your son and doing all these daily activities and running real estate business? How do you create that time, and how do you, delegate that time that's given?
Yeah, I love talking about this. I mean, in this aspiring woman achieving more thing, I think anybody who tries to do a ton of stuff runs into this, but I think that the mom guilt flavor of stuff is a particularly hard pill to swallow and deal with. So I love a chance to get to talk about this. So thank you. For me personally, it wasn't a really obvious solution, but if I block my time, if I'm really strategic in terms of when I'm doing whatever I'm doing, I can go all in on it. You've heard The One Thing, you've heard, potentially the book Deep Work, all of these things informed that whenever I'm doing one thing, I'm 100% here with you. And I have no concerns that my kiddo is playing with his nanny right now. And I don't feel bad about it because mama's chasing her dream. And I want to show him this example of, you can figure out anything you want to figure out. We can do hard things, right? So that's one really big thing. Go all in on whatever you're doing. And I time block time with my kid, so that I can be 100% on with him, and that relieves some of the guilt in a big way. One more thing that I do in terms of getting stuff done, there's a lot of science behind the switching in your time, right? So I'm very strategic in terms of batching activities. I drive a lot for my day job. So I'll yell at, hey, Siri, call the dentist. Hey, Siri, whatever. So I have this call list so that whenever it's time to make calls, I have this 2-hour time block to make calls. I just bang through those calls or bang through those emails or follow-ups or whatever it is, so that I don't have the brain switching stuff that forces me to lose a lot of impact in terms of that time. I actually did a video on this on my website blog. So MandyMcAllister.com if you want to see more.
Got it. So on that note, and I think I heard Siri as well. Was that Siri?
You did?
Yeah. Here you go. So
I'm trying to hide her now.
That's how it works. So again, the book that Mandy mentioned, it's Deep Work by Cal Newport. I think that's the book, right?
Hmm.
Yeah, so that's
Yeah.
the book if you want to go and grab it. I never read it, so definitely it's going to be on my list as well. So
Good.
personally, I don't know, I just want to get your personal take because what's currently happening with technology and kind of machine learning, artificial intelligence, and including real estate is getting disrupted right now, where you can actually go from a tenant perspective, you can virtually see all the kind of leasing and the options before you
Mhm.
actually physically go and see them. And from buyer or seller standpoint, the deals are happening right now virtually. When we're talking about $10 million deal, people signing checks virtually, never looking at the deal, itself. So basically, it's never been done before. So do you see something like that from kind of disrupting and technology standpoint that will kind of change real estate industry going in the future?
Look, if in my opinion, if you look at any big areas where there's a huge delta of cash to be made, it's because one group has a ton of information and one group doesn't have a ton of information, right? If you think about, what this high frequency trading stuff did to, the stock market, or gosh, even going from the pits to the screen, to the trading on the computer, that it's when everyone involved has access to the same amount of information, then the margins get smaller. So what that tells me from my own approach is, okay, number one, I'm going to be able to have more information to manage these assets better, which is important. And I need to, what you manage improves, right? So that's one thing. But in terms of acquisition, we've got to be ready for these margins to be smaller. They just are. They're getting competed out. There's a ton more people and a ton more big money in this, space. So, how can you look in a spot that maybe not everybody's looking?
Mm. That's the question. That's the question. How do we spot the opportunities before they show up? Because once they show up, once they see them on a Facebook ad or somewhere else, or it's too late. So and that's the
Yeah,
key.
exactly.
That's the key. Mark Cuban said, exactly the same thing. Is like he said, I'm great at spotting opportunities and looking behind the corner before those opportunities shows up. So and that's I mean
Mm.
that's really tough. That's really tough because you have to have a lot of information already within you to carry those decisions and to that you're pulling the right decisions. So of course there's
Mhm.
more to that. But from a personal portfolio, in a minute when you talked about acquisition, so again, I understood that you're not going to be pulling trigger on the deals that don't make sense. But what's currently happening with your personal pipeline, and how much more of the deals you're looking to acquire? Because again, it's December right now. Let's say in the next year.
Yeah. So in the next year, I think I'd be remiss if I didn't pay attention to the political landscape and what that's gonna do. I think that probably in the, gosh, even maybe this month, the smaller stuff, a lot of mom and pops will want to unload for fear of the change of capital gains taxes. So I have my ear to the ground for the smaller stuff for my personal security bucket that we talked about. In terms of the larger stuff, what I need to see in order to move forward is comfort with that downside and a ton of cash flow with long-term debt. That's what matters to me. Because end of the day, sure, the pop in money that you get from a value add, that only happens once, and you have to sell, basically, in most cases, sell the asset in order to achieve that. I don't want one-time money. I want forever money. I want these streams of cash coming in for myself and my partners and my investors. So we've got a really strong focus on forever money cash flow.
Got it. Got it. Okay. So, I mean, there's so much more that we can probably uncover and dig into, and we probably need to make another 2 or 3 episodes on that, which definitely we should, because I mean,
I'm in.
yes, exactly, because we're leaving a lot of stuff on the table, but with the time that's given, I don't know if I think making separate podcasts will be the best type of approach. But of course, for more information for you who are watching or listening to this, mandymcallister.com. Again, Facebook page. She does a lot of great stuff for the women. It's called Aspiring Women on Instagram and Facebook. So all of these groups and Instagram accounts, everything is going to be linked in the show notes. So go and check it out. And the last question that I have for you personally, I mean, besides what you're currently doing, I mean, you have your hands full. And again, you have a second generation now coming after you, a 4-year-old son. So what is your personal legacy that you want to leave behind you?
You know, one of impact, one of that, you know, anything is really possible, that, you know, I am 0% special. I just don't give up, you know, that's it.
And that is good. You should not never give up, especially in these times like these. You know, I mean, people who will not quit, and whatever you do, it's real estate, sales, anything, you know, just not quit on life, and don't go, you know, down spiral, you know, in the bottom, because it's easy, especially during these times.
Yes.
So that's good, you know. So definitely go and follow Mandy for that personal inspiration and for the strategies. I'm sure there's a bunch to keep you, you know, afloat, not just afloat, but to succeed in real estate business. So get in contact with her personally, ask her questions about active real estate investing. You want to invest passively, go ahead and do that. And one thing that guys and girls, I want to ask you before we're going to go, if you, of course, pass this episode along to your friends, it could be any friends. Again, you like the friends, you don't like him, hate him, love him, doesn't matter. That person needs to hear this message, because again, times are tough and people are looking for their answers, for the strategies and tips. And this episode is full of those. And again, Mandy, for you personally, big thank you for coming over today and sharing your personal journey, tips, strategies, why and how people can get involved with real estate investing. I appreciate it.
Thank you so much. I'm really grateful.
Thank you. Thank you. So guys, again, make sure to pass this episode along. And as always, I'll see you next time. Thanks for watching.